Hello everyone, my name is Anjali Kumar Khetan, and in this particular video we will continue our discussion from last week where we discussed India's response to BEPS Action Plan 4 by way of introduction of Section 94B to the Indian Income Tax Act 1961. Now in this particular video we will look at the illustrative case studies and will give you a more granular understanding of Section 94B. How does it practically apply in real life situations? So we'll look at the first case study where an Indian company or an assessee in India pays interest both to the A's and non-A's, and we will see how Section 94B actually works in practice. So scenario 1, we have a case here that let us say you have ICO, an Indian company. Now this ICO is a resident in India and incurs total interest expense of rupees 80 million, out of which 10 million is paid to the foreign AEs and the balance 70 million is being paid to non-A's. Now if that be the case, and also assume that the EBITDA of the Indian company in this particular case study is 200 million. And we have seen Section 94B has a threshold for 30% of EBITDA from the perspective of interest deductibility. So let's see this here. So as I mentioned in this case study, ICO is overall paying a total interest expense of 80 million, out of which 10 million is to the two A's and the balance 70 million is to non-A's. Now, at the right hand side, if you see, total interest therefore is 80 million, EBITDA is 200 million, 30% of that 200 million EBITDA is 60 million. So 60 million is the threshold which is there under Section 94B. Let us see how the calculation will work and how do you determine what is allowable, what is not. So we have the EBITDA of 200 million, then 30% of the EBITDA is 30% of this amount, 60 million. Now, how much they have paid? They have paid a total of 80 million as an interest, out of which amount payable to AE is 10 million and to non-AE, let's say a third party independent bank, is 70 million. Now, the calculations we have seen in the previous video, what excess interest is. Excess interest is something which will be disallowed, and therefore from the perspective of Section 94B you have to compute these two numbers: total interest paid or payable in excess of 30%. Now 30% of the EBITDA is only 60 million, and what you are paying in excess is in total is 80 million. And therefore, if you look at, let me clear this, if you look at here, considering that your EBITDA is 60 million, 30% of the EBITDA is 60 million, and interest paid or payable collectively to AE and non-AE is total 80 million, and therefore the first component is 20 million, which you have to compute. And then out of this, the second component which you have to compute is how much of the interest is payable to the AEs, which is 10 million in this case. Now, from an excess interest perspective, we have seen in the earlier video by way of a theoretical framework, lower of these two numbers is something which is disallowed as an excess interest under Section 94B. And therefore, if you look at lower of these two numbers is 10. So 10 million of interest would be disallowed in this case. So what will be allowed to you? Total of 80 minus 10, which is disallowed. So in all, what you will be allowed is 70 million. Now, if you see here, in this case, the key takeaway which you have to understand, the threshold is 60, 30% of EBITDA, but you are actually paying 70 million to non-AE. Still, the entire 70 is allowed, because the idea of Section 94B was not really intended to curb the third party interest payout. It was always, the intention has always been to make sure that the excessive interest to the AEs, the associated enterprises, are not being paid. And therefore, in this fact pattern, the total allowability of the interest is 70 million, corresponding to what you are actually paying to the non-AE. So even if this 70 million exceeds 30% of the EBITDA of 60 million, still the entire 70 million, the way the calculations are designed in section 94B, it is allowed. So even if more than 30% of the EBITDA, total interest to AE is allowed. Nothing is disallowed. Let us see another case study. Here, interest is only to AE, no third party, non-AE to which you are paying the interest. So let's see here. Similar example, you have a scenario, ICO is an Indian company, they are paying a total interest of 80 million. But this is only to AE, nothing is being paid to non-AEs. And again, similar to the previous case study, the EBITDA is still 200 million. So in this case, the entire 80 million is being paid as an interest to AE, foreign AE. Okay. And again, similar to the previous one, 30% of the EBITDA total is 200, 30% of EBITDA will be 60 million. Now let us see how the calculation will work in this case. Same way as we computed in the previous case study, 200 is your total EBITDA, 30% of that is 60. You are paying a total interest of 80, but this entire 80 is to AEs. Nothing is to a non-AE. And therefore, you are having a total interest of 80 as your expense. Now, you have to still compute these two numbers. Excess of interest paid or payable in excess of EBITDA, 30% of EBITDA continues to be 20. But then, the amount which you are paying to the AEs is 80. Therefore, in this case, lower of these two amounts, the lower of the 80 and 20 will be disallowed. So therefore, in this case, 20 will be disallowed. What you will be allowed to claim deduction is only 60. So therefore, if you look at the key takeaway which you have, interest to AE, if it is being paid beyond the 30% of the EBITDA is restricted, interest deductibility is restricted to 30% of the EBITDA, which is 60. So the way the calculations work in section 94B, in this case study, you paid 80 million. 30% of EBITDA is 60 million only. And therefore, by operations of the requirement of section 94B, your interest deductibility, because you are paying only to the AEs, will be restricted to 60 million and balance 20 million will be disallowed. Of course, this 20 million, as we have seen, can be carried forward for next 8 assessment year from an Indian perspective. That is something which is permitted under the Indian framework. Section 94B does allow you to carry it forward for next 8 assessment year. Let us see the third case study. Here, the interest expense is only to third party. External third party is not related to the entity. So, interest is only to non-AEs. Nothing is being paid to the related party or the AEs. Similar example, you have a EBITDA of 200 million, but you are paying a total interest of 90 million, and this entire 90 is to third party entities which are not within the group. They are not your associated enterprises. Same way, we will just brought in EBITDA of 200 and 30% of that is 60. Now see the calculations at the bottom. Same way. This is the 200 is your EBITDA, 30% of that is 60 million. Now here you are paying 90 million of expense, but the entire 90 is to non-AEs. You still got to compute the same two variables to determine the allowability or otherwise. So therefore, you will first compute total interest paid or payable in excess of the 30% of EBITDA. You have these two numbers. So therefore, in this case, you are paying 90 million of interest, which is 30 million more than 30% of EBITDA of 60. And therefore, in this case, the first element or the first computation will say that total interest paid or payable is 90 in excess of 30% of the EBITDA, and therefore 30 is your first calculations. Now, how much you have paid to the AEs in this, to the non-A's in this case is, not to the non-A's, paid or payable to A's, which are non-resident. So, how much you have paid to the A's is 0. And therefore, lower of these two amount is 0. So, therefore, in this case, nothing will be disallowed. This is in consonance with the first case study where we said that even if the interest paid to non-AE exceeds the threshold of 30% of EBITDA, the law never intended to disallow that. And therefore, in this case as well, the entire interest is being paid to non-AE. The way this section operates, because you have paid everything to the third party independent companies or entities not within your group, they are non-A's, and therefore the entire 90 will be allowed, even if this 90 million is greater than or more than 30% of your EBITDA. So this is the takeaway. Interest to non-A's is not disallowed, even if it is more than 30% of the EBITDA, and this is being ensured in the way that the legislation has been done in section 94B. Now, this brings us to the last case study for the day, which is, remember, we have spoken in one of the previous video regarding the guarantee being given by the AE for the debt which has been, or the loan which have been given to the Indian company, or the, so let us see this case study where the debt is guaranteed by the AE, and by virtue of that guarantee, or maybe equal and matching amount, corresponding amount being deposited by the foreign AE with a foreign the lender. So let's see this case study. What happens in this case? Look at the left hand side. Here, ICO is an Indian company. They have borrowed 90 million from HCO, or I say HINC. Now, HINC is not their related party. It is a third party independent entity. Okay. They have raised 90 million from HINC at 10% interest rate. So 90 million of loan at 10% interest per annum. HINC is the tax resident of UK, and of course this ICO is in India. See the next third point. The loan is guaranteed by FCO, who is also a tax resident in UK. Now this loan which is given to ICO is guaranteed by FCO, and FCO is also tax resident of UK. Look at this one, the fourth point. Also, there is another entity called UCO. If you see, UCO is also a UK-based company. That this UCO holds more than 40%. They have shares carrying 40% of the voting rights in both ICO as well as in FCO. So, let me summarize what is happening here. Here, the loan is being given to ICO by a non-AE. But FCO is a company which has given a guarantee to the non-AE on behalf of the loan which has been given to ICO. Now, in this fact pattern, what is happening? UCO is a company which have shareholding in both ICO and FCO. And in each of these companies, it is holding more than, or let's say in this case, 40% of the voting rights in both the companies. Now, the additional financial details are given to you with respect to this ICO. That ICO has net profit after the interest on this loan of 9 million. After that 9 million of the loan, or the 9 million of the interest, depreciation and income tax, the net profit of this Indian company is 11 million. And depreciation and income tax applicable to ICO is 5 million and 4 million respectively. Now, this financial information is already given to you. Now, with this said, the question is, how do you calculate the disallowability or maybe allowability, as a contrary to the disallowance under section 94B. Now, if you look at here, what is interesting to note is that in this case, UCO, what is UCO? UCO is a shareholder in both UCO is holding 40% in ICO as well as in FCO. So UCO is holding more than 26% voting rights in both of these entities, ICO and FCO. And therefore, under the Indian transfer pricing rules, these two entities will be deemed to be the associated enterprises because the threshold of 26% is there under the Indian TP rules in terms of who is regarded as the associated enterprises. So entities within the same group, same control, which are holding more than 26% voting rights, and therefore in this case, because UCO is a shareholder in both ICO and FCO, which is more than 26% threshold, and therefore FCO and ICO are also deemed to be the associated enterprises. And since loan taken by ICO, though the loan has been taken by ICO from HINC, but because the deemed AE, FCO has given guarantee. Here, guarantee has been given by FCO, such debt will also be deemed to have been issued by the AE, and therefore the requirements of Section 94B on interest limitation will get triggered. You can see my last video. It has a lot of details. In this is the page of my YouTube channel where you will have a lot of discussions, including the last video which I have uploaded on these aspects. You can look at it if you have missed it, so that you will be able to better appreciate what this is all about. Now, with this said, that in this fact pattern, since Section 94B gets triggered in this case, now how the calculations will work, let us see in the next slide, and then we will conclude our discussion for today's. So, if you see here, unlike the previous three case studies, here you have to do the computation of EBITDA, because EBITDA is straightforward, is not given. What have been given to you is the net profit of 11 million, but this 11 million of profit is after three things. After 9 million of the interest which you paid, plus interest and depreciation. Interest, depreciation and tax. So interest of 9 million plus depreciation and tax of 5 plus 4 million. So therefore, you have to add them back to get your EBITDA. So to the 11 million number, you have to add these three numbers to arrive at your EBITDA. So your interest, 10% of that 90 million loan which you have, plus as given in the case study that depreciation is 5 million and interest, your income tax is 4 million. So if you add all these four numbers, your EBITDA will become 29 million. Now, 30% of this 29 million is 8.7 million. So this is your threshold for the purpose of Section 94B, right? 30% of 29 million. Now, if you see here, ICO has incurred interest expense. In this case, ICO has incurred how much the interest expense? 9 million. So 9 million compared to 8.7 million. So ICO incurs interest expense exceeding 1 crore. 9 crore is the 9 million here in this case. Okay, exceeding 1 crore for the debt issued by the non-AE in excess of 30% of EBITDA. Provisions of Section 94B will get triggered, and therefore now you have to compute. What you have to compute is again the two parameters which is required to calculate the disallowance. So total interest paid or payable in excess of 30% of EBITDA. 9 in excess of 30% of EBITDA. 0.3 million would be your interest, the first leg. And secondly, how much is the amount which you have paid to the A's? In this case, it will be deemed that the amount has been paid to the A because of the fact that the debt has been guaranteed by a deemed A. And therefore, lower of these two numbers will be a disallowance. So lower of 0.3 million and 9 million, 0.3 million will be disallowed. Lower of these two numbers will be disallowed by operation of Section 94B. So what will be disallowed to you is 8.7 million. Right? That's how it is. Now, for all, see, because there is you may say, let us read this entire thing crores rather than millions. Okay. I just realized that here, that because of the threshold of 1 crore, let us read all of these numbers in crores. So that means for the purpose of the clarity, let's say 11 crore is your net profit. This much is your addition. So your EBITDA is 29 crore and 30% of the EBITDA is 8.7 crore and the disallowance will be 0.03 crore. 8.7 crore will be your allowed. In the case study, I've just changed the unit from million to crores. Just read in that sense. Now in this case, what will happen? Here, if you see how much interest here is here in this case, though you are paying 9 crore, but the disallowance of 0.3 crore will work and what will be allowed is only 8.7 crore. And this 8.7 crore corresponds to what is 30% of EBITDA. So here also, because the entire amount of interest is being paid or deemed to be paid to the AE, it is restricted again to 30% of EBITDA. Of course, as we have seen, disallowed interest in this case of 0.3 crore can be carried forward to 8 subsequent assessment year. Would be allowed as deduction provided other conditions of Section 94B is met and it is otherwise allowable under 94B. So that's how you have to look at the requirements of how you practically apply Section 94B in various scenarios. So with this, we conclude our deliberation for today's video. You have my link of my YouTube channel and my LinkedIn page. Please, connect with me, subscribe to the channel and support the channel the way you can do in whichever way it's possible and feasible from your perspective. Subscribe the channel, comment on it, maybe comment in terms of any specific topic or the video you want me to cover. I will try to certainly cover those topics. And do maybe share it with your known people who are in need of these kind of a informative video. So that's my request, and that's pretty much for this particular video today. And with this, I'll take a pause. We will see you in another video next week. Till then, take care. Bye for now.